LIFO is just the opposite of FIFO. So that means last in, first out. The last purchases are the ones that are going to go out first in cost of goods sold. The oldest units are the ones that are going to be remaining in ending inventory. So the example I gave you there is a sand pile. So let's draw a little sand pile here. Somebody sells sand or dirt or something. And here's a little forklift operator. And he's got a big bucket or whatever of dirt that when they bring in new inventory, they just pile it on the top of the sand pile. Okay? That's a horrible illustration, but you get the idea. So they just pile it on top of the old stuff. It doesn't matter. Sand is sand, dirt is dirt. And so they just put it on here. The newest purchases go on top. What does the customer do whenever he comes and purchases sand or dirt from these people? Well, he's not going to dig all the way to the bottom to get the oldest stuff. He's just going to pull something right off the top. Okay, so we're trying to match the units that came in with the units that are going out. In this example, our cost flow assumption is LIFO. The last ones that came in, they go on top. They're the ones that are pulled off by this guy. So the last ones in are the first ones out. Okay? Sorry for that illustration, but maybe you get the idea of what we're doing there. So now it's opposite. LIFO. Last in, first out. What does that actually mean for this group up here? Well, how do we calculate ending inventory? Our ending inventory is based on the oldest purchases there, okay? So we got the 10 units at the $5 cost for 50. And then we have another 10 units from this bucket here from the March edition times 7, extended cost of 70. Total those together, we get 120. So LIFO, the cost is 120 there for our ending inventory. Now you see that FIFO is a lot higher than LIFO in this example. And that is going to be the case when we have rising prices. In this example, during the year, we went from $5 to $7 to $9 because ending inventory under FIFO is based on the most recent purchases. Those are going to be a higher cost here, and LIFO is going to be a lower cost. What does this mean for our gross profit or our net income? Well, it's going to be the opposite. Your profit under FIFO is going to be the highest. Your profit under LIFO is going to be the lowest in a period of rising prices. Okay, last thing, what is the average cost method? That's on page 2 there. What the average cost method does is it says, well, we don't really know where these are coming in. It could be anything, the first units, the last units, the middle units. So what we're going to do is we're going to assign an average cost to all these units based on the total cost of all our products and the total units. So we would look at how many units did we have during the period 50? What was our total cost of 360? What is our average cost there? So we would do 360 divided by 50, and that number is $7.20. Okay, so each one of these 50 units we're saying is worth $7.20 regardless of whether it went out during the period or whether it's still there in our ending inventory. So we would just take this $7.20 times it by our 20 units that are left, and that would give us $1.44. $1.44. And you see that makes sense because the prices are rising here, and this is in between the FIFO and the LIFO amount. Okay, so we have 4 different calculations here for ending inventory. This is one of the reasons why accounting is an art, not a science. There's a lot of estimates that are going on. Make sure you understand how each of these 4 different methods work and how you calculate the different amounts, what the logic is, and do an example problem. There's an example, I believe, on page 214 to 218, which is a really good opportunity to make sure that you understand how this is going. But hopefully this little example helped you through some of the things that are going into how we make these calculations. Okay, let's look at final comments for Chapter 5. Lower cost of market rule. Essentially what that says is, regardless of what we paid for it, if we know that we cannot sell it in the market for what we have it on the books at, we need to write that down. We need to take a loss whenever we know that information and record it at the lower of the cost that we paid, which is one of our cost flow assumption methods that we just looked at, or the market value of that amount. So the lower cost rule says the lower of the two is what we recorded at. For example, if we use FIFO and we said 170 was our cost, but the market was 140, we would need to record our inventory at 140 to write that down an extra 30 to record a loss for that drop in price. If something goes out of style, for example, if we bought all these clogs back in 2004, you know, the shoes that people wear, and then 3 years later that was out of style and we still have those on hand, the market price might be lower than the cost, so we would need to write those down. Make sure you review inventory errors. Inventory is one of the accounts that self-corrects. Because of our formula, which has both beginning and ending inventory in there, you might have an error on your ending inventory in 1 year. Well, that is going to reverse itself in the following year when you have the same opposite error in beginning inventory, but your two periods are going to be incorrect. And then you'll definitely want to know ending inventory turnover and number of days in inventory. That's on page 212 and 213. Make sure you look at those calculations. Okay, quick things about Chapter 6. SOX, Sarbanes-Oxley. That's something that for the profession of accounting has been pretty revolutionary. That changed the way that public accounting firms operate. All public companies, not I'm talking about public accounting firms, but public companies that trade stock are required to do an internal controls audit in addition to their financial statement audit. So that came about after the Enron Henderson scandal in 2002. You might want to just put in to Google or Wikipedia Sarbanes-Oxley and just kind of read some of the things that how that came about. It's kind of an interesting history lesson for the field of accounting. And also, if you haven't looked at some of the scandals, I think it talks about that earlier in the book with Arthur Andersen and WorldCom, etc. That might be an interesting thing to look at as well. Segregation of duties. The idea here is that we're dividing up responsibilities so we don't have one person that can completely take the company down. Custody, authorization, and record keeping are the three functions that you'll want to separate with 3 different people. So, for example, on cash, you want to have somebody who keeps the custody of the checks, like in a lockbox or something. Authorization, the second person would be somebody who signs the checks in order for it to be validated, and then the third person would be a bookkeeper or accountant who records the checks whenever they go out. Make sure you segregate those duties so that you don't have one person who can steal money. The only way to get around segregation of duties would be for these people to collude, which obviously does happen, but you want to at least make that more difficult for them to do so. Petty cash on 254 to 255. This should be pretty simple for you to look at. Let me know if you have any questions with that. And the bank reconciliation. Hopefully you've done this. Nobody really does this anymore because people do online banking, but if you ever reconciled a checkbook, this is essentially what you did. You take what you have in your checkbook ledger, comparing it to what is on the bank statement. You're doing this for the company, basically. Usually there's one accountant who does the bank reconciliations for all the bank accounts in the company. 259 to 261 is the examples of those. You'll often have journal entries that you'll be required to make as a result of this process. For example, a bank charge might be listed on the bank statement, but you won't have it in your register, so you'll need to record a journal entry for that. Other errors can be found during the bank reconciliation process. So make sure you read that section and understand what you do, but that's kind of basic, so I'll leave that to your review. The last thing I wanted to do was give you a devotional for the week. This is one of my favorite books. It's called The Damnation of Theron Ware. It's by Harold Frederick. Probably haven't ever heard of it before. I hadn't either until about 3 or 4 years ago when I was at Asbury Seminary. It's a book that came out in the late 19th century, I think 1896 as the published date. Well, you say, oh, that's kind of old. I've never heard of it before, but it is a classic. It's a great book. I've read it about 3 times. Just finished it a couple weeks ago. It's about a Methodist minister who comes to a new congregation. It's set in New York, and he's in this new setting. You know how the Methodist Church works or the Wesleyan Church. Often you're appointed by a bishop to go on an itinerant system for a couple years at a time, and so they change situations, change locations a lot. And he basically continues to make one bad choice after another, and goes from a really holy outlook and holy lifestyle to something that is just essentially a travesty, and loses his faith. Essentially, it's a warning. It's about 300 pages. It's a work of fiction. It's not a true story, but essentially it's a warning to make wise choices, to associate ourselves with a Christian community, to live in faith. And it's just a really good book. I'd encourage you to check out the link that I have for you there, the Amazon page. Can read about it, but it's a great book, and I would highly recommend that to you if you want. So keep up the good work. This has been Chapter 5 and 6. We'll discuss it in the discussion forum, and I will see you next week for Workshop 5. Thanks.